Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. It is January 30th, 2026, and the markets are, well, they are certainly keeping us on our toes. Today, we're breaking down one of the most interesting and I think one of the most controversial companies on the market right now, the global audio giant, Spotify. And on the surface, it's a fantastic business. It's a powerful brand. I mean, everyone uses it.
Oh, yeah. It's ubiquitous.
It's on your phone, it's in your car, it's probably playing in the background for some of you right now. But the real question for us as long-term investors is this. The stock is trading near all-time highs, sitting right around 510 euros.
A staggering number.
It is. And it's got just a staggering valuation of 82 times earnings.
Hmm.
So the question is, are we witnessing the maturation of a true monopoly that actually justifies this kind of premium? Is this a margin expansion miracle in the making? Or are we walking right into a classic valuation trap where absolute perfection is priced in, but, perfection is not guaranteed?
Right. And that's what we're here to find out. That's a huge topic, and honestly, the tension in this stock right now it's palpable. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them.
Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this. Because I think for a long time, the market and, frankly, a lot of users just looked at Spotify as that app where I play music.
The utility.
Exactly, a utility. You press play, music comes out. Simple. But looking at the internal data we have for Q3 2025 and just seeing how the company has evolved over the last 12, maybe 18 months, it's clear that the engine under the hood has completely changed.
It has. And if you're still analyzing Spotify as just a music streaming service, you are frankly missing the forest for the trees.
You're looking in the rearview mirror.
Completely. You have to stop thinking of it as a record store in the cloud. That's the old model. That's the 2018 model.
So what is the 2026 model? What are we looking at today?
The new model, the black box, if you will, is that Spotify has become an aggregation machine for global audio rights.
Aggregation machine, I like that.
It's not just music anymore. That's the key. It's music, it's audiobooks, and it's podcasts. They are aggregating all of this disparate content, which used to live in different apps, different ecosystems, even different physical formats.
Right, I'd have my podcast app, my Audible app.
Exactly. And they are bundling it all into one seamless experience. They're essentially renting access to this giant audio bundle to 713 million monthly active users.
That distinction, renting access versus buying content, is so vital. But I want to drill down on the economics of this because that's where the bear case used to live.
Not for you.
I remember vividly, back in 2022 or 2023, the biggest knock on Spotify was that variable cost structure. The argument was always, Spotify creates no leverage. Every time I listen to Bohemian Rhapsody, Spotify has to cut a royalty check to Queen and their label. If I listen to it 1,000 times, they pay 1,000 times. It was a nightmare for scalability.
Exactly. That was the fundamental flaw in the original model. In software, what you want is fixed costs and infinite scalability.
Sure. Write the code once, sell it 1,000,000 times.
A billion times.
Yeah.
Spotify was the opposite. They sold the subscription once, but the costs kept climbing the more you actually used the product. It was a business model designed to bleed cash if your users were actually engaged.
Which is just so ironic. Usually you kill for engaged users.
Right. But what we're seeing now, and specifically in this Q3 2025 update, is that fundamental transition. They are moving from that purely variable cost structure to a fixed recurring revenue model via premium subscriptions. But, and this is the important part, they've managed to decouple the costs slightly through the podcast and audiobook verticals and by completely changing how they negotiate with the marketplace.
And the most tangible evidence of this shift, for me, is the pricing power. This is where I want to spend a moment because this really surprised me.
It surprised a lot of analysts. I think Wall Street got this wrong for a decade.
For years, the prevailing narrative was Spotify is a commodity. The thinking went, if Spotify raises my bill from, say, 10 euros to 12 euros, I'll just cancel and go to Apple Music or YouTube Music because they have the exact same songs.
The content is fungible.
Right. It's not like Netflix, where if I want to watch Stranger Things, I must have Netflix. Taylor Swift is everywhere.
That was the theory. Audio is a commodity, therefore price elasticity should be high. Price goes up, demand goes way down.
But looking at the data from the last 18 months, That just didn't happen.
No, it didn't. In fact, the data completely refutes the commodity argument. It shatters it. Look at the last 18 months leading up to late 2025. We've seen significant price hikes in their most critical markets, the US, the UK, the EU.
And these weren't small tweaks.
No, these were substantial increases in the monthly fee. And what happened? Did users flee to Apple? Did they run to Amazon?
Not at all. The average revenue per user, the ARPU, it stayed resilient at €4.53 across the blended global base.
Yeah.
That's impressive on its own, given their growth in emerging markets, which pulls the average down.
Right.
But even more shockingly, subscriber growth actually accelerated. It was up 12% year over year. They hit 281 million paid subscribers.
Just stop and think about that. They charged more money and more people signed up. That breaks the basic laws of commodity economics.
So what does that tell us? What's the real insight there?
It tells us something profound about what the product has become. It has shifted from being a utility, something nice to have, to what I would call a tax on audio.
A tax on audio.
The price elasticity is incredibly low. People are so locked into their playlists, their listening history, their recommendations, and just the interface that they simply absorb the price hike without blinking. It's become like electricity. You might complain if the rate goes up, but you aren't going to disconnect your house from the grid.
That brings us directly to the concept of the moat, because you don't get that kind of pricing power where you can raise prices and grow users at the same time without a serious economic moat protecting you.
Impossible.
In our synaptic framework, we usually look for network effects. And with 713 million users, that scale is undeniable.
But is it just about having the most people on the platform?
It is, but it's not just the raw number of users. That's a vanity metric. It's what that data from all those users allows them to do. We call this algo-editorial lock-in.
Algo-editorial. I like that word. Break that down for me.
It's the blend of algorithm and editorial curation. This is the real secret sauce. Think about your Discover Weekly playlist or the new Daylist feature.
I love Daylist. It's creepily accurate. It is. Or even just the Smart Shuffle feature. These features have commoditized discovery. 10 years ago, if you wanted to find new music, you had to be an active participant. You read blogs, you checked Pitchfork, you asked your coolest friend for recommendations. It was actual work.
I remember that. I remember digging through SoundCloud for hours trying to find a gem.
Exactly. It was a hunt. Now, Spotify just feeds it to you on a silver platter.
Yeah.
It anticipates your needs before you do. That creates a soft lock-in that is arguably stronger than any contract. If you leave Spotify for Apple Music today, you aren't just losing your saved songs. You can transfer those with third-party apps. That part is easy.
Sure, I can move a playlist in 5 minutes. No problem.
But you cannot transfer the brain. You are losing the digital brain that knows exactly what you want to hear on a rainy Tuesday morning when you're feeling slightly nostalgic but still need to focus on your work.
Yeah?
Apple Music doesn't know that about you yet. It would take years, literally years, to retrain a new algorithm to that level of intimacy.
That's such a good point. I've actually tried switching services before just to test them out. And the pain of retraining the algorithm is real.
It's awful.
It feels like starting a relationship over from scratch.
Yeah.
You're sitting there skipping song after song, just shouting at your phone, "No, I don't like country music. Why are you playing this for me?" It's exhausting.
It is. It's high friction. And in a world of convenience, friction is the ultimate retention tool. But there's another layer to this moat, right? We have to talk about the competitive landscape, and specifically what we call the Switzerland argument.
Right. This is what we call counter-positioning. Because, look, the competitors here aren't small startups. We are talking about Apple and Amazon.
The two titans.
Two of the richest, most powerful companies in the history of humanity. They have infinite cash. They can outspend Spotify 10 to 1, 100 to 1. So why haven't they just crushed Spotify?
Because of their own business models. Think about it. Apple Music is a fantastic product, but what is its primary purpose?
To keep you in the Apple ecosystem.
Exactly.
To sell iPhones and AirPods and HomePods.
Exactly. It works best on an iPhone with AirPods, maybe a HomePod. It's designed to be a beautiful walled garden. Amazon Music. It's designed to make your Prime subscription stickier and to sell you more Echo devices.
But Spotify doesn't care what phone you have.
Exactly.
Yeah.
Spotify's neutral, it's agnostic, it works seamlessly on an iPhone, an Android, an Alexa, a PlayStation, your car, your smart fridge. It doesn't matter. This neutrality is a massive structural advantage that the tech giants literally cannot replicate without cannibalizing their own hardware sales strategies.
So they're hamstrung by their own success.
Perfectly put. Spotify is the Switzerland of audio. If you're a household with mixed devices, an iPhone for mom, an Android for the teen, a PC for gaming, Spotify is the only logical choice that works for everyone.
So we have sticky users, we have real pricing power, and we have a neutral platform that works everywhere. It really sounds like everything is firing on all cylinders. In fact, looking at the stock chart for 2024 and into 2025, it's just been parabolic.
Yep.
It reminds me of that concept that Charlie Munger used to talk about all the time.
The Lollapalooza Effect.
Yes, God rest his soul. When you have multiple forces all pushing in the same direction at the same time.
It's a perfect application of that mental model. Usually in business, you're fighting headwinds. Maybe you have growth, but your costs are rising. Or you have efficiency, but the market is shrinking.
It's a constant trade-off.
Here, you have three distinct, powerful forces converging at once to create a super result.
Okay, let's map those out for everyone. What's force number one?
First, you have a mature market saturation in the West that is finally allowing for those price hikes we mentioned. The land grab phase is over. Now it's the harvest phase.
Right.
Second, you have extreme cost discipline. We can't ignore the layoffs and the efficiency drives of 2023 and 2024. They cut the fat, they got rid of moonshot projects, and the organization got faster and meaner.
Leaner and meaner.
And third, and this is so critical, you have these new verticals, podcasts, and audiobooks that were burning cash for years, finally turning the corner and becoming margin accretive.
It's the trifecta. Revenue up, costs down, and new profits kicking in from old investments. But I want to touch on the human side of this for a second. We have some notes here on the internal culture. Usually, when a company does massive layoffs, and Spotify cut a significant percentage of its workforce,
They did.
and pivots to this efficiency mindset, the culture just rots. People get scared, innovation stops, everyone just tries to protect their own job.
It's a very common death spiral for a tech company.
But looking at Glassdoor and the sentiment analysis we've done on engineering blogs, it seems surprisingly okay. Am I reading that right?
Chaos controlled is the phrase that comes up again and again. It's
Yep.
definitely a shift. The moonshot R&D days where money was no object are gone.
Your car thing era is over.
Oh yeah, you can't just launch a car thing hardware device and burn hundreds of millions anymore. But the core engineering culture remains top tier. I mean, they're still ranked number 43 on Forbes' World's Best Employers list.
That's still very, very high.
It is. And the ultimate metric for culture in a subscription business isn't just employee happiness, it's user retention, it's churn. If the engineers were unhappy and shipping bad code, the product would suffer and users would start to leave.
And the churn numbers are just incredible.
Industry leading. Less than 4% globally, and in developed markets like the US and Europe, it's under 2%.
Under 2%.
That is unbelievably sticky. That tells me the people who are building the product still care deeply about the product.
Okay, so the business engine is humming. Let's move to pillar number 2 and look at the actual scorecard, the financial resilience. Because for years, the knock on Spotify was great product, terrible business.
A classic bear case.
They just couldn't make money. It was the classic tech trap growth at all costs, but the unit economics were completely upside down.
And that is where the Q3 2025 report drops a smoking gun. If you only look at one number from this entire deep dive, ignore the subscriber count for a second, ignore the revenue growth, just look at the gross margin.
It came in at 31.6%.
Which is massive. I cannot overstate how important that single number is.
Okay, put that in context for us. Why is 31.6% so special? What was it before?
Historically, for almost a decade, Spotify was stuck at a 26% gross margin. They hovered in a tight band between 24% and 26%. Wall Street analysts for years thought that was a ceiling, a law of physics for their business.
Right.
They said, because the labels take 70 cents of every dollar, Spotify can never structurally get above 27, 28%. It's impossible.
It was the label tax. It was baked in.
Right. So breaking 30% and then hitting 31.6% is the proof that the thesis is working. It proves they have finally broken that law of physics.
So what changed? How did they break that ceiling? Did they just bully the labels into better deals?
It's not just negotiation, it's structural innovation. It's the marketplace strategy finally bearing fruit. This is where Spotify turned the tables. Instead of just paying labels, they started charging artists and labels for promotion.
Explain how that works. That's a bit counterintuitive.
Well, imagine you are a label, you have a new artist you're trying to break. In the old days, you paid for radio play or billboards. Now you go to Spotify and say, I want to be in the discovery mode.
Okay.
Spotify says, okay, we will boost this song in the algorithm, we'll put it in front of more listeners, but in exchange, you accept a lower royalty rate on those promoted streams.
Ah, so it's essentially ad tech. They are selling exposure and reach back to their own suppliers.
Precisely. It's become a two-sided marketplace. That, combined with the podcast division finally stopping its cash bleed and turning profitable, is what drove this incredible margin expansion. And every single percentage point of gross margin expansion falls straight to the bottom line.
And that connects directly to the operating leverage, too. We're finally seeing the decoupling everyone was promised.
Right. A total decoupling. This is the Jaws chart that every software investor dreams of seeing. Revenue grew 19% year over year, but operating expenses were flat to down.
Wow.
When your revenue goes up almost 20% and your costs stay flat, your profits just explode.
That is the holy grail of software scalability. That's the whole point.
And it resulted in a major inflection in the operating margin to 13.6%. They posted 582 million euros in profit in a single quarter. We are moving from a company that was, flirting with break even, sometimes losing money, sometimes making a tiny profit, to a literal cash machine.
But I have to do it. I have to play devil's advocate here.
Please do.
I have to channel the skeptics and, frankly, my own annoyance with how a lot of tech companies report their numbers. We always hear about stock-based compensation, SBC.
Okay.
It's the hidden expense in tech.
The famous add back.
Right.
Yeah.
Right. Critics will say these profits are fake because they're just paying their employees with stock instead of cash. So on paper, they say, look, we made $500 million, but they just issued $200 million in stock to do it. It dilutes me as a shareholder. Isn't that just accounting magic?
It's a totally valid challenge, and we need to be honest about it. We can't gloss over it. SBC is material here. It's estimated at about 6 to 8% of revenue, and that is a real cost to shareholders because, as you said, it dilutes your ownership.
My slice of the pie gets smaller.
Exactly. If they print more shares to pay their staff, your slice is worth less.
So is the profitability real or is it fake?
Yes, it is real now.
Yeah.
And here's why the fake profitability argument is losing steam for Spotify specifically. The profits are just too big now.
Oh, okay.
With 582 million in operating income, even if you treat that, let's say, 150 million of SBC as a pure cash expense, let's just pretend they paid it in hard cash,
Yeah.
they are still generating massive, genuine owner earnings.
So even after you apply the SBC penalty, they are still printing cash.
Correct. 2 or 3 years ago, SBC was wiping out their entire operating profit. Now it's just a line item. It's a cost, yes, but the machine is generating more than enough surplus to cover it and still have hundreds of millions left over.
So the cash is real.
Yeah.
And that leads to the question of what they are doing with it. Capital allocation. Daniel Ek, the CEO.
Yeah.
His reputation has evolved, hasn't it?
Mm-hmm.
I remember looking at him in 2019, 2020, and he just looked like a kid in a candy store with a blank check.
He was. We're calling this his report card evolution. A few years ago, during the shotgun M&A era, he was buying everything. Gimlet, Parcast, The Ringer.
Bill Simmons?
He spent hundreds and hundreds of millions of euros acquiring content studios.
And a lot of that money was, let's be polite, incinerated.
It was inefficient capital allocation. It was. They bought shows that didn't travel globally. They bought tech they didn't really need.
Yeah.
But that era is over. The capital allocation hierarchy is now very, very disciplined.
It seems like it's R&D first and then buybacks now.
Exactly. They are reinvesting in the core product, which they should be doing. You have to keep the algorithm sharp. But then we saw a really interesting signal in Q3, a 157 million euro share repurchase.
Which is interesting because the stock is at an all-time high. Buying back your own stock when it's expensive, is that smart? Usually you want to buy low, sell high.
That's the debate. On one hand, it signals that management believed the stock was undervalued, even at these elevated levels.
Get in the game.
Right. On the other hand, it might just signal they have so much cash they don't know what else to do with it. But as we move into Pillar 3, we have to seriously question if they are right. Is the stock actually undervalued up here?
Yes, let's transition to Pillar 3, valuation and the Red Team Challenge. Because this is where the rubber meets the road. We can love the product. I love the product. We can love the margin expansion. It's seriously impressive. But at 510 euros a share, are we paying too much?
Let's just start with the big number. The market cap is around 100 billion euros,
Mm-hmm.
and the trailing 12-month PE ratio is 82.1.
82. Just let that sink in for a second. 82 times earnings.
It's a nosebleed valuation. There's no other way to describe it.
I mean, if I buy a local business, a bakery, a car wash, I might pay 3 or 4 times its annual earnings. If I buy a great mature company like Coca-Cola, maybe I pay 20 or 25 times, 82. That is priced for absolute flawless perfection.
It is. When you buy a stock at 82x earnings, you are effectively making a bet that nothing will ever go wrong again. You are betting on unblemished execution for the next decade. No hiccups allowed.
So let's run the math on that. We did a reverse DCF, a discounted cash flow analysis, but working backwards to see what the market is implying. If I pay 510 euros today, what does Spotify have to do to give me a decent return?
Okay, so to justify paying 510 today and getting just a standard 10% annual return, which is roughly what you'd hope for from the S&P 500 over the long run, Spotify essentially has to compound its free cash flow at 20% or more every single year for the next 10 years.
20% growth for 10 years straight at this scale.
That is exceptionally rare. I mean, you can count on one hand the number of companies in history that have done that at this scale.
And just to put that in another perspective, just to burn off that high multiple, to get the PE down to a more reasonable level, like 25 or 30, they need to triple their earnings in the next 5 years.
Right, and that's just to have the stock price stand still, essentially. If they triple earnings and the stock price stays flat, the PE normalizes. But as an investor, you want the stock price to go up, so the hurdle is absolutely massive.
That is a high, high bar. And when we ran our own synaptic estimate of intrinsic value, we came up with a pretty different number, didn't we?
We did. We tried to be realistic. We used what's called an owner earnings model. We estimated their 2026 free cash flow at a huge 2.5 billion euros.
So we're giving them a lot of credit.
A lot of credit. We're assuming the margin expansion continues. But even if you take that huge number and you slap a premium quality tech multiple of 25x on it.
Which is still a very generous multiple for what is fundamentally a media company.
It is. But if you do that math, 2.5 billion times 25.
Yeah.
You get a valuation of about 62.5 billion euros.
And the market is trading it today at 100 billion euro.
Exactly. So there is a gap of about 35%. And that gap is the hypergrowth premium. You are paying a 35% premium right now for growth that hasn't happened yet. You are paying for the hope of 2028, 2029, and 2030, but you're paying for it today.
And that leads us to the red team challenge. This is the kill argument, the thing that genuinely keeps me up at night regarding this stock. We call it the Netflix trap.
This is the most dangerous narrative for investors holding the stock right now. The argument is simple. You are buying a maturity story. Their growth is slowing, their margins are stabilizing, but you are paying a hyper-growth multiple. That mismatch is terrifying.
Do you remember what happened in 2022?
Vividly, it was a bloodbath.
I remember looking at my portfolio. Netflix was the king. They had won the streaming wars. Everyone had Netflix. They were profitable. And then they posted one bad quarter. Just one.
Yeah.
Subscriber growth stalled slightly.
And the stock crashed 70%. 70 in a matter of months.
70%. Billions and billions of dollars of wealth just evaporated overnight. And why? It was because the market suddenly woke up and realized, oh, wait, this isn't a tech company that grows to the moon forever. This is a TV station. This is a media utility. And utilities do not trade at 50x earnings.
That is the risk here, 100%. If Spotify reports one quarter where MAUs monthly active users go flat, or even just disappoint expectations, look out below. The multiple will compress from 80x to 25x so fast your head will spin.
And Spotify has a risk that Netflix didn't even have to the same degree. At least Netflix owns some of its content. Spotify doesn't own the music.
Correct. This is the supplier risk. This is huge. Netflix owns Stranger Things. They own Squid Game. Spotify is fundamentally a reseller of intellectual property owned by the major labels Universal, Sony, Warner. They have a structural gross margin ceiling.
It's the paradox of their success, right? If Spotify starts making too much money, let's say their operating margins go way above 15%, the labels are going to look at that and say, hey, wait a minute, you're making all that profit off of our artists.
Exactly. Retaliation. Universal Music Group is not a partner. They are a supplier with immense monopoly power. They can, and they will, say, nice little margins you have there. Be a shame if something happened to them. We're raising our royalty rates.
So you are paying 80 times earnings for a business where your biggest supplier can arbitrarily decide to renegotiate your cost of goods sold at any time. That is a fragile position to be in.
It is. It's a business where you are constantly squeezed between the consumer on one side who doesn't want to pay more and the supplier on the other who always wants to be paid more.
Okay, so that's the danger. That's the hold or sell argument. But we can't ignore the potential. The market isn't stupid. There is a reason it's priced this high. Let's look forward. Pillar 4, the future of the firm. We're looking at the 2030 vision, because if you're holding this stock today, you are betting on a major pivot.
You're betting on the pivot from music app to Creator OS, an operating system for audio creators.
This is fascinating to me. The idea is that subscriber growth in the West is going to plateau. I mean, it has to. Everyone who wants Spotify in North America pretty much has it by now. So the future has to be vertical integration and ARPU expansion.
And the TikTokification of the app.
Right. If you open the app now, you can already see it happening. It used to just be a list of songs and albums. Now, video podcasts, music videos, short clips.
They have to do this. They need to become a full-blown consumption ecosystem. It's not enough to capture your ears anymore. They need to capture your eyes.
Why?
Because audio is a passive medium. You listen while you drive, while you work, while you cook. That's great for retention, but it's terrible for advertising. Video commands active attention, and that's where the real ad dollars are. They need to compete with YouTube and TikTok for that budget.
And there are new verticals that could be absolutely huge. We've seen them start to pilot education content.
The sleeper hit. This could be massive. Think about a masterclass Lite built right into Spotify. Video courses on how to play guitar, how to cook, how to code, taught by experts.
Why is this better for them than just streaming music?
Because of the margins. It's all about the margins. Unlike music, where they pay a royalty for every single stream, or podcasts where they have to pay big guarantees to creators, education content is often a fixed cost or a revenue share on a one-time purchase. If they sell a course for €50, they might keep 15 or 20 euros of pure profit.
So if they can capture even a tiny sliver of the e-learning market, that's just pure profit layering on top of the core music business. It creates a blended margin that is much, much higher than 30%.
And then there's live events, the other big one.
This one just seems so obvious. I mean, everybody hates Ticketmaster.
Everybody. It's a universal, shared human experience of frustration.
Spotify knows who my favorite bands are. They know I listened to the new Killers album 50 times this week. They know I live in London. So why am I buying my concert tickets on a completely different website with insane fees?
Exactly. The current integration is so clumsy, it just links you out to another site. But by 2030, you should expect Spotify to try to disintermediate Ticketmaster. They want to be the venue for pre-sales.
A direct relationship.
You are a top 1% fan. Buy your ticket right here, right now in the app. They want that rake on billions and billions of dollars in global ticket sales.
Okay, so let's paint two scenarios for 2030. The bull case and the bear, or maybe base case. Let's start with the golden goose. What does that look like?
The golden goose scenario sees revenue hitting 50 billion euros by 2030. Gross margins expand to 35, maybe even 40% because the revenue mix shifts so heavily. Music becomes the loss leader. It's the cheap milk in the back of the grocery store that gets you in the door.
Right.
But the real money, the high margin money, is made on audiobooks, creator tools, education, and ad tech. In this world, the company is worth 250 billion euros.
That's a 2.5x from where we are today. That's a 20% annualized return. That's a home run.
That's the dream. That is what justifies paying 510 euros for the stock today.
Okay, but what about the utility trap? The base case.
This is where things stall out. Revenue only hits about 35 billion euros because developed markets are saturated and emerging markets just don't monetize well. And the margins, they stall at 30% because the labels refuse to budge and they demand their cut of all the other verticals.
The label tax strikes again.
In this scenario, the company is maybe worth 120 billion euros in 2030.
Which would mean, from today's price,
dead money. The stock basically stays flat for 5 years while the earnings catch up to the valuation. You'd get a 3 or 4% annual return. You'd be better off in a savings account or a government bond.
Ouch. And we have to mention the structural risks looming on the horizon. The biggest one has to be AI.
The AI flood. We are predicting that by 2028, 90% of new uploads to the platform could be AI-generated music.
This is weirdly a double-edged sword for them, isn't it?
Yeah.
On one hand, royalty-free AI beats for sleep music or focus music actually saves Spotify a ton of money. They don't have to pay Drake for white noise.
Right. It lowers their costs significantly. There is a huge amount of listening time spent on functional audio rain sounds, lo-fi beats to study to. If Spotify can replace all of that with AI they own, they keep 100% of the money.
But there's always a but.
But if they push that too hard, If the algorithms start prioritizing AI sludge over real human artists just to save a penny, they risk angering the major labels. If Universal Music Group pulls their entire catalog because they feel Spotify is favoring AI, the platform dies overnight. It's a very dangerous tightrope to walk.
And then there's the other big one, the super app competition. ByteDance, TikTok.
The elephant in the room.
Yeah.
If TikTok launches a global music streaming killer, which they are absolutely trying to do, that bundles perfectly with their viral video feed that could evaporate Spotify's discovery mode. If kids are finding all their new music on TikTok, why would they ever open the Spotify app? That is the existential threat.
So what does this all mean for an investor today? We've covered the margin miracle on one side and the valuation trap on the other. Let's wrap this up with our final investment verdict.
Okay, let's break it down by quality and price.
The quality score of the business itself.
It's high. I'd give it an A-. This is a dominant global platform with a visionary founder in Daniel Ek. The unit economics are clearly improving. The shift to fixed costs is real. It is a wonderful business, no question.
Oh, valuation score.
Expensive. AOD. I'm sorry, but there is just no margin of safety here. You are paying for a decade of flawless execution, and that's a tough bet to make.
So the thesis is essentially hold.
Time is the friend of the wonderful business, as the saying goes. If you own it from 100 or 200 euros, you hold on tight. You let the compounder work its magic. But putting new money to work up here, that's a different story.
So strategically, if the stock were to drop significantly,
If we see this stock under 350 euros, that's where it becomes an aggressive accumulate for me. That's a price where you can see the long-term compounder math working out without needing a series of miracles.
but right now, over 500 euros.
I'd say that's a trim or a hedge. If you have a huge position, maybe take some chips off the table. You are effectively paying 2030 prices in 2026. You're prepaying for 5 years of success, and a lot can happen in 5 years.
It's a classic case of a great company, but a tough stock at this specific moment in time.
Exactly. Investing is all about the gap between expectation and reality, and right now, the market's expectations are sky high.
Before we sign off, I want to leave the listeners with a final provocative thought. We talked about AI. I want you to imagine a world where Spotify's algorithms, driven by that efficiency culture, start prioritizing AI-generated sleep music over the new Taylor Swift album, just to save a few basis points on margin. If the platform becomes a utility for background noise rather than a home for art and culture, does it lose its soul? And if it loses its soul, do the users eventually leave?
That is the ultimate question, isn't it? Efficiency is great for margins, but emotion and connection are what keep us subscribed. If they kill the magic to save a buck, they might just kill the business in the long run.
Something to mull over. Thank you all for tuning in to this deep dive on Spotify.
We'll see you in the next deep dive.